Good day, fellow investors. Will the market crash? Will the Fed push it higher, higher and higher? What should we do? Well, in this video we'll give you a market overview, economic overview, fiscal stimulus, what are the central banks doing and how is that impacting the markets, discuss the risks and rewards of investing in this current market, and then give you some random thoughts to finish the video. All in all, I really want to give you as much value as I can so that you can make your own investment decisions. If you enjoyed that, please click like, subscribe to this channel as we discuss investments, value investments. We make a lot of stock analysis and we look for general long-term investing trends that are low risk and high reward. So what happened to the market over the last year? We have seen the biggest economic crisis due to COVID lockdowns, but the market is where it was at the beginning of the year. Year to date up 4%, over the last year up 12%, but it peaked on September 2nd. The joke on Wall Street is that on September 2nd, what happened? Why did stocks started going down, crashing? Because all the day traders, the app traders, Robinhood investors, those that look for stocks below 15 bucks, below $5, because they had to go back to school. So that's the reason for the crash, of course. Let's continue. But the run-up was created through the Fed, through fiscal stimulus, and we're going to discuss that too. All in all, the crash, the 30-something% crash, was the shortest bear market in history. It took 126 trading days to recover the losses. That was, what, 30% of the earliest shortest recovery of 310 days in 66. Now, when it comes to market overviews, you can always go to valuation. And if we look at the Shiller price to earnings ratio, the cyclically adjusted price to earnings ratio that takes into account average 10-year earnings, the price earnings ratio of the S&P 500 is at 30. The mean historical is around 16, minimum was 4.78 in 1920, maximum 45. Now, from a valuation perspective, if the price earnings ratio is 30, you can expect a return around 3% plus a few percent of growth from inflation, and that's 5%. That's still good in this interest rate environment. But historically, when the price earnings ratio was so high at 30, the real returns were just above zero for the subsequent 15 years, yearly returns. So, okay, real returns, as I said, 3% to 3%, depending on inflation, depending on what's going on. And here we are. This is the ballpark to expect, to be happy with. Of course, it can be also negative 4%, but it can also be a little bit more positive, the maximum coming to 4%, but don't expect more. In a zero interest rate environment, this is the market. Investment banks, of course, are telling you you should buy every possible dip out there. Stocks will continue to go up forever. Well, that's their business. If they say, no, don't do anything, stocks will crash, they don't get their commissions. So that's something to think about when JP Morgan says that stocks will go higher. But will stocks go higher or not? That's something we have to put into perspective, because what are the forces driving the market, except for the Robinhood traders that are not now back to school? The forces driving the market are the Fed, fiscal stimulus, and economic recovery that is better than expected. Let's look at the economy. What are central banks doing globally, how it impacts currencies, stock market, real assets, values, and then continue with our investment discussion. So the forecast was 6% that the global economy will decline 6%. Now it's already 4.5%, which is much better than expected. Even countries like China will not see an economic decline over 2020. That's really, really remarkable, and that gives you also insights on investing. When it comes to investing, companies expose their commodities perhaps, etc. But it also shows the resilience China has, and they are also doing stimulus like everybody else, but they are stronger in this case, and they will emerge likely stronger in 2020. So that's very interesting. The hardest hit countries will be emerging markets, India, Argentina, of course, Mexico, because they don't have the stimulus power that the US has, Europe, China, Japan. And if you don't have that, then you are always on the margins of the financial world, and therefore you are hit the hardest, unfortunately. As you can see here, the projections for GDP decline for India, Mexico, South Africa are even bigger than those were earlier in June, but China will likely grow almost 2%, the US will decline only 4%, the world also something like that. Euro area will decline a little bit more. UK, always the hardest hit economy, because that's how their economy is set up. Higher booms when things go good, but big declines where things go bad, like in 2009. Unemployment rate is already down to 8.4%. The Fed's target is 4%, so still a lot to go. But if it continues like this, with the stimulus, with everything, and the economy starts improving, we might see it sooner than expected, which is very positive also for the market. One of the reasons why the economies did so good is fiscal stimulus, and this is something very important to discuss because there are different impacts of this. This is for Germany, and their deficit is expected to be, I think, 7.5% in 2020 as they spend more on stimulus, etc. But 7.5%, and their total debt to GDP ratio will be at 71%. So it's not just what central banks are doing, but also what governments are doing. 71%. If we compare this to the US, the debt to GDP ratio is 136%. That's double what Germany has. And the deficit will be likely 17.9%, more than double what Germany has, and then also 2021. So we have a conservative Germany and a much less conservative US. And this also has repercussions on currencies, on economies, on how the markets see what's going on, and perhaps not so much the Fed's activity. We'll see later it's lower than Europe and other countries, but the stimulus, the fiscal stimulus, and the mounting deficits there might be the reason why the dollar is weakening. Now, the ECB will try to weaken also the euro, because a strong euro is not good for the economy, but that's the game they are playing, and we as investors also have to see how to work with that. The OECD said, don't take off the stimulus, because if you take off the stimulus, then the economies are going to crash. And that's also the thing. In 2018, when the Fed started increasing interest rates, when the ECB started lowering asset purchases, everything started crashing even before the COVID crisis. So we are now living in a world of fiscal and monetary stimulus, and that's it. And that's something we have to get used to it. And when investing, we have to see how that works and what is the risk and reward. Now, let's look at what are the central banks doing. The Fed said they will do whatever they can, they will be very powerful, and they will use all the tools at their disposition to lower unemployment to 4%, reach price stability, leave inflation a little bit higher, and improve the economic situation. They will do whatever they can from a monetary policy perspective. But don't forget, you also have the fiscal policy perspective, where they are now fighting in the US how much stimulus should they give, same in Europe. So we will see how will the coordination be, because the monetary policy at some point it can do much more, because interest rates are already at zero. You can push more money into the system, but if it doesn't trickle down to the economy, then you can't help much. And this is the Fed's idea. They have zero interest rate and they plan to keep it up till 2024, longer term increase it, but for the next 1, 2, 3, 4 years we can expect to have zero interest rates, which means cheap money, free money, also something to take into consideration when it comes to investing. Of course, this is what they project. If I just show you what they were projecting not even 2 years ago, it's completely different. So they project, but they know they can be very wrong. So in 2018, their projection was the interest rates were higher, that in 2020 we'll have interest rates just close to 3%. Every dot here is the committee individual projection of a person in the Fed's committee. But 2.9, are we at 2.9? Have we been at 2.9 in 2019? No, it already started declining prior to the current situation. So yes, longer run, they hope to get 3%, but you never know. They don't even know, because you don't know what will happen. There are so many factors impacting this that's impossible to project. But of course, they are saying they will do this, so we can implement this into our analysis and discussions, but never take anything they say for granted, because it has been different and it will be different than expected. So they said they will keep interest rate at 0 until labor market conditions have reached levels that they expect, 4%. Inflation has risen to 2% on average, so even higher than 2%. Let it exceed 2% for some times, not to make the 2018-19 mistake where they slowed down the economy and it was not necessary. So here you see the target for 2023, 4% unemployment rate, inflation, longer run 2% target. They are buying mortgage securities and treasuries, but what does this mean? We have interest rates at zero. Hopefully inflation higher than 2-3%, which means that the real interest rates will be negative. So the savers, pension funds, insurance companies will all be the losers. Also something to keep in mind when it comes to investing. But what the Fed has been doing, but probably mostly what the governments with the fiscal deficits have been working on, has led to a significant weakening of the US dollar. But this might also reverse, because other countries, European, Japan, UK, Switzerland, and others, might change their policies in relation to their strengthening currencies. So it's all a currency game, and you never know who will win. For now, there are a lot of people shorting the dollar, so we might even see a short squeeze when the dollar starts going up. When it starts going up, it will definitely start going up sometimes, because currencies are always volatile. And the fact is that other countries are doing the same as the Fed, a little bit less fiscal stimulus, but that will likely come. Now that they have started with that, there is no going back. The ECB started buying again. We have seen over the last 5 years they put more than 3 trillion, 2.8 trillion euros, 3 trillion euros at the end of August into the system. And despite that, given Germany's fiscal conservativeness, the euro has strengthened against the dollar in this crisis time, but it's just where it was in 2018, so nothing miraculous there. This is normal now. They're strengthening, weakening, etc., and depends on the actions later, it will go higher or lower. But look at this. This is the Bank of Japan, in proportion to GDP, owns 135% of assets of GDP. And the Fed owns the least. So if you look from a monetary policy, the United States Fed has done the least of other banks, which again signals how more fiscal stimulus, less monetary stimulus, still room to do more and more and more. Now, when it comes to investing, how to position yourself, I think each one of us has to look at all the possible assets, be it gold, real estate, stocks, whatever you own, whatever you base your financial future on, and then look at from a risk-reward perspective the quality of what you have in relation to what's coming. More fiscal stimulus, more monetary stimulus, more recessions, ups and downs. They can try to financially engineer a lot of things, but you never know how will that work. Some say budget deficits are not important anymore. Some say those are important, some say there will be a crash, but the fact is that nobody knows, because we are, as always, in uncharted territory. For now, we know there is plenty of money, there is a lot of liquidity coming into the market, so we have to see how that liquidity, at what price, fits best your portfolio, depending also on the country where you are in. So I have made just a little chart here. If we look at risk, high risk, low risk, quality of an investment, just to give you an example, you see what best fits you. We said inflation will hopefully be at 2%, but not average, and financial assets might go even higher. Real returns are negative, nominal might be close to zero. And then risk, what is risk? Is it just volatility or business long-term risk? Let's discuss this a little bit and see how an investment fits your portfolio. So if we start with US Treasuries. I think that the risk is very high because there is no risk. Actually, there is no risk. I am sure that if I put my money into the 10-year Treasury, I lose it because of low nominal rates, which means negative real rates. So the quality is low and the risk is high for something like this. You can bet on Treasuries that rates will go even lower, but that's betting, that's not investing. Then we discussed Barrick Gold. You might want to see how that fits. Let's say medium risk, medium quality. It has a 5% yield. Then we discussed Apple, a little bit more quality, high cash flow. So we can say low risk from a business perspective, but more risk from a volatility, from a market perspective, because the price-earnings ratio is above 30. But 3% yield is still better than 0.69. So these are the things you have to see. Okay, will this lead to my financial goals or not? That's the most important question. We discussed some Australian shares, likely 5 to 6, 7% returns there, but then there are currency issues that increase a little bit the risk of this. There is stimulus depending on how air traffic recovers there. So Intel is another interesting stock that has higher cash flows now, but depends on how they will manage to fight for their market share. And then also real estate, given the cost of money, likely inflation ahead, it might be a low risk opportunity now if you structure it well and really good quality. So you have to see how these investments fit your portfolios. Don't ask me which of these stocks will go up, because that's just betting. That's not investing. We are buying real assets here with real returns, and those real returns compound over time, and we become wealthier, so that we are well off in 10, 20, 30 years. Betting, yes, you win some, you lose some, you don't go far ahead. Build on real assets, and that's the best answer I can give you, because that works in any environment. Just some random, when I was reading the news and preparing this, just some random thoughts. So investment, foreign direct investment into the US from China and from the US into China up to 2017, really high, good, growing, and now declining. So nobody is a winner. There is never a winner in any kind of war. That's the unfortunate truth and the consequence of this. Instead of both the Chinese and the US being richer thanks to collaboration, they are both poorer now thanks to what they are doing. Now, the rebound will come for emerging markets with the delay always compared to developed markets, but we see here how bonds, people already started to buying higher yield bonds there. So this will likely, if things keep looking good over time, also spill over to other assets. So it might be again a good time to look at emerging markets. And this is something very interesting. Coal really destroyed from renewables the energy shift in the US, so really declining consumption of coal and increasing of renewable energy. So also be careful with these long-term trends, headwinds, tailwinds, and try to invest in tailwinds, not in headwinds, if you don't really know what you are doing. So the conclusion is manage your risks, whether when it comes to investing. Will stocks crash, will not? We don't know. What we can do is know what we will do in case if this or that happens, and how is our portfolio structured from a risk-reward perspective. Prepare for probabilities. If I would have to answer, I would say 76% the market will be pushed higher from the Fed. It is a tailwind pushing all things higher, so we should be invested, but 24%, perhaps even less, that it will be all doom and gloom, or I'm sure it will be volatility. Let's say 20% volatility ahead, no return over the next 10 years, no real return, and a 5%, 4% of a real doom and gloom chance. This would be my thinking when it comes to investing. So buy the dips, yes, but think long term and think how it fits your portfolio.